I'm just going to tell you that our firm was started, this firm, because I've had many. I grew up in Chicago, came to Texas in 1977. In 1987, I had a heart attack. I used to weigh 358 pounds. And I had a heart attack. My son came to my house because he had to mow the lawn and all that stuff. And he had just got out of UTD, and he said, University of Texas, North Texas, and he said, I want to go into business with you. I said, well, I don't want to do what I was doing before. I sold that business. It was really not very, I was teaching other CPAs and attorneys how to do pension plans and how to do tax planning. I said, I want to do everything. I don't want to just be a select, because I don't want to teach my competition how to compete with me. It really was not a very smart, even though it was a big company and it did very well. So we started the Glazer Group, which is made up of about 6, 7 other companies. My son is my partner and has been a 50% partner from the day that he joined me. And that's really nice, because people ask me, they say, well, you're not young. I said, well, I feel very young. And you know, none of us have a contract, so I can't give you a date. But you know, everything is great. But my son is going to follow through, and he'll be here to take care of you. And we have a staff of 30 people. And now my grandson worked all summer. He's at Oklahoma State University studying accounting, and he's worked with us all 2 summers, and he'll be joining us in a couple years full time. So we have a ongoing hierarchy that's going to run the company. So people always say, hey, there are people, plus I have 30 accountants, 15 of which are accountants who are prepare returns or do tax planning or whatever it might be. And we do other things. We do investments, insurance, property and casualty, whatever. So we're full service, and what we try to do when I talk about creating net worth, all of that has to do with what we're doing. You know, our biggest cost is always taxes and penalties, even though people say, well, my biggest cost is my car or my home or whatever. No, really our biggest cost is taxes and penalties. It's a real issue. These are required disclosures I have to get. And our firm was set up with the idea, when I set it up, I said, you know, our commitment is to provide, you know, sound financial information, help you identify goals, and offer complimentary consultations. That's our mission statement. Whoops. Myself, I've actually started, it says 1960, but I actually started in accounting in 1957. My uncle made me take a bookkeeping course. I wanted to be a pharmacist, because all my cousins were pharmacists and they were making a lot of money. I said, well, I want to be a pharmacist. But the pathology stuff sort of like turned me off, you know. I got to do all that pathology, as all of you know, or most of you know anyway, that are doctors. And he said, well, you got to learn accounting anyway. Even if you run a pharmacy, you got to know bookkeeping and that kind of stuff. So shortly after I took that bookkeeping course, he started referring clients to me. So in 1957, I started doing bookkeeping and simple tax returns and things like that. And slowly but surely just developed into an accountant. And by the time I graduated college, I was making like $1,500 a month doing bookkeeping and all that kind of stuff and tax returns, which is a considerable amount of money in 1962. I think I was the 3rd highest grade out of Roosevelt University grade. I wish my grades were that high. The 3rd highest salary with the major firms, and it was only $475 a month. So, you know, if anybody who can go back that far, when you got out of school or when you started practicing or whatever you were doing, you know, the salaries, you know, have increased drastically. I speak at numerous seminars. Recently, over the last probably 12, 15 years, because of my tax background, I worked for a large audit firm, and you know, did a lot of tax and foreign and whatever. And about 12, 15 years ago, there was a tremendous need for international tax seminars for people who moved offshore or who were investing offshore. Lot of interesting things. I've written articles or whatever, in that pamphlet and booklet we passed out is a lot of articles. I've been written up in the Dallas Morning News and been on some of the local channels. I've been written up in the New York Times or whatever. A lot of that stuff is in there. There's a lot of other information. I'm a U.S. tax, I consider myself a tax planner with extensive foreign tax experience. But interestingly, we also have 5 or 6 financial planners within our organization. So our main function is tax planning, because that's where I really feel the majority of our costs. That's where all of us usually get caught, is on the tax side. And as I said, my partner is David. We have 30 employees in Dallas. We have 2 down here in San Antonio, and we have 20 up in Illinois who do all our pension administration. So we have quite an organization. And what we're trying to do is we want to work with our clients. You know, as I say, we have 3,500 clients. It's gotten so bad that I really can't remember everybody who walks in the office, because it's spread out amongst 6 or 7 consultants and 15 accountants. So a lot of times it gets so massive that it's hard to remember who's who. What we do is we really focus on the person. What are you trying to accomplish? Where are you trying to go? What are you trying to do? When do you want to retire? You know, what are your needs? We're not the type of firm that comes in. We're not H&R Block or any of the other accounting firms where you say, give us your stuff at the end of the year and we'll prepare your tax return. It goes way beyond that. It goes into what I consider to be planning. You know, we need to think short-term, long-term. You know what? And we start planning in January. So right now, we're finishing up people's tax returns for 15, and of course we're already planning for how we're going to end up 16, and then we're actually already starting for some of our bigger clients what's going to happen in 17. Now, I don't know how many accountants that you work with are in that situation, but it's a big job, and my accountants really don't like us. Thank God David runs the day-by-day operation, because he takes all the flack. But the point is that it's very difficult to take a client and be working with them on an ongoing basis, trying to explain to them what they need to do. You know, things change. We've got to be flexible. We've got to adapt. We feel we lead the field. I don't know many accounting firms, financial planning firms, even the big ones, like Bank of America, I just heard, they can't, they've got to do all of their stuff with Bank of America. And I guess we're in that same situation, but we're better than Bank of America, to be honest, from my standpoint, and I think I could get a lot of testimonials if it was legal that people would say that. And interestingly, you know, people don't understand that things are changing constantly. This is Obamacare. Of course, it makes a lot of sense, right? Obamacare, that chart, everybody could understand it. And of course, if you look up at the top right-hand side, there's 3 letters there. It said IRS. Who would ever think that the IRS would be in Obamacare? Who would ever think that Obamacare, 2 years after it was instituted, or 3 years, that we got a 3.8% increase in tax that's buried in Obamacare? Who would know that? You know, people look at things and they say, oh, that can't be. Why did my taxes go up so high? Well, they stuck that in there, 3.8%. So if you make more money, you know, like $250,000, then you're going to have an increase in your tax liability. Well, how many accountants have been planning for you to have paid that tax in? That's what we try to get to. It's, you know, so things change. The other thing is that the IRS takes an opportunity every time there's a new bill passed. This was a highway bill. They're putting in roads and bridges and highways, and they say, well, what does that have to do with anything? Well, they changed the whole structure where the dates, the dates that tax returns are due are changing. And you say, gee, why would they do that? Well, they're looking at how can they speed up the collection of taxes. Now, I look at things, I'm constantly deferring. I'm looking at pushing my tax liability into the future. I'm not trying to, I don't want to pay it today. I want to make it pay enough in so that at the end of the period that I've had the tax paid in. But, you know, we have to remember that the government is always trying to increase taxes. That's why we got to be very careful when we're looking at what the conversation is. I grew up in Chicago, as you know, so that puts me in one category. And then I have been in Texas now for 40 years, and that gives me in a different category. So when we look at things, we got to really look and say, why have they done this? What are they trying to do? And no matter which party you're voting for, we got to be careful of the increased taxes. But we have to be ahead of it. I was going to bring a briefcase full of stuff. I just went through my entire office. I do a radio program once a week called Tuesdays with Maury, which is a book, as everybody might know. And so I do the radio program, and I have these stacks of things that I read every week, every day. And I was going to bring it because I was going to set it up here and say, this is what I read. But I read probably 1,000 pages of tax information. And the reason that I do that is because it's changing so fast, you got to keep up on it. And I look, and of course I got to look at the international side, and I got to look at the U.S. side, and it's all part of it. And in today's world, everybody says, well, what's FATCA? Well, there's a lot of people who either talk about immigration. A lot of people have immigrated from other countries over the last few years, and what we're finding is a lot of those people have foreign bank accounts. A lot of those people have foreign businesses, and the government, of course, has collected somewhere between $10 and $20 billion from people who had inherited or who had made money and left it in Switzerland or wherever, Philippines, wherever it might be. And FATCA is the foreign account transfer rule. And what they're doing is they're saying, hey, you know, if you haven't reported your foreign bank account, if you haven't reported your foreign trust, if you haven't reported your foreign corporation, and you've made money, interest, dividends, or whatever, you got to pay tax on that. And what FATCA does is it turns around and actually requires you to report those foreign earnings. And if you don't, then the banks, I don't know if anybody have heard, the banks will then withhold 30% on transferring of money. And it's a real big issue when you have to withhold tax on money that you're transferring back and forth. The other thing is the government is, if you haven't paid these taxes or you haven't filed your tax return, you potentially could lose your passport. I've had several friends who have gotten off an airplane and been stopped, and the government, whatever DEA or ATF or whatever agency it might be, and they take the passport away and they take them away because they haven't paid their tax, haven't filed their tax returns, and people think it's silly, but like me, I cruise a lot, I'm out of the country. You know, I sure as heck need my passport, you know, all of us. FATCA impacts your business. Current withholding change, classification of foreign workers, Form W-8 and W-9, which are new forms and whatever. We have to be real careful. And actually, there are many entities, trusts, corporations, bank accounts, whatever it might be, that have to be, partnerships, have to be reported to the government. They used to have what they call a foreign offshore voluntary disclosure program. That's where they collected 10 to 20 billion. But what has happened is, and I've done a lot of these cases, probably done 50 to 100, And what we've done is we do these cases where people come forward and say, oh, I have this bank account in Switzerland, I have this bank account in Israel, wherever it might be. So the government, what they do is they take that information and they go to the banks and say, okay, we want to know every individual that you have that has a foreign bank account with your bank. So that they no longer have to do the voluntary disclosure. What they're going to do is they're going to cut that program out, and they're just going to go after the list of people. That's what happened in Israel, Switzerland. All these countries have turned over, and that's why you can't open today a foreign bank account. I have a client in Hong Kong who's trying to open an account in Hong Kong. He's from Panama. He's actually a U.S. citizen, but he can't open an account in Hong Kong because of the situation in regards to these foreign account situations. He's got to be there 5 years. He's got to have permanent status, whatever it might be. So we all have to think about what all that is going to do. And when you look at it, the disclosure program, what they call foreign bank account, Form 114, there's all kinds of different things that we have to think about reporting. Even if you have investments from offshore, you got to file Form 8938, which lists all your foreign assets. And the important thing is, if you have these things, you have to remember on Schedule B, there's actually a question at the bottom of the page, which most accountants have failed to fill out. It says, do you have any foreign bank accounts? You can't say no if you do. You got to say yes. And then if it's over $10,000 in any month, then you've got to file a Form 114 disclosing where the bank is. It's the highest amount in any month during the year. Now, everybody says, well, what's the big deal? Well, the big deal is a civil penalty, a minimum of $10,000, and a maximum of maybe 50% of the account balance for each year. So I have clients who ended up giving away more than they had in their trust. The other thing that has been happening, of course, and I forgot to bring it, I actually have it in my briefcase, I believe, are these scams that are going on. You know, we all have issues now with identity theft. And the current one, there was an article in the Dallas Morning News, which actually we have a fellow we know real well, an attorney that works for Keller Williams, and his name is Hank Ronstein. And Hank had come up with this about 3-4 years ago, where he was saying that people were stealing the money coming in for real estate purchases. Well, in the Dallas Morning News, I guess this says popped its ugly head up again. So if you're buying a house, you got to be very careful, because people will call and say, oh, send us the money to X and X and X, and then these people are not really the people who are buying the house. So you got to be real careful on any transactions you do. They call this the dirty dozen: identity theft, telephone scams, phishing, with the help of unsolicited email or fake websites, false promises of free money. The other thing is, you got to be real careful with who you do your tax returns. You got to really confirm who the people are. Now, just because they're H&R Block doesn't necessarily mean that they're appropriate. You know, you got to make sure who the person is, and do they have the proper credentials. And of course, as some people might say, well, gee, I don't need to know about foreign situation, but someone might say, hey, why don't you give me the money, we'll take it offshore, and then you don't have to report it or something like that. Got to be real careful. You can't hide income. Charitable organizations, I get it all the time, where I get these, well, I'm from the Patrolmen's Association, I'm from this, I'm from that. You know, can you send me $50, $100? Got to be real careful, because a lot of these are not correct charities. So you got to be real careful. In fact, I just turn those people away. I try to do things that are pretty well established. It just goes on and on about what people do, and preparers. You know, the big one is child care credits and things like that. That's the big one. That if you have someone who does that regularly, oh yeah, we can get you. You got 2 kids, we can get you an extra $2,000 or whatever credits. Got to be real careful. about doing that, because those accountants, preparers, are the ones that are on the IRS watch list. A lot of people are still out there, you know, going back 15, 20 years ago, there were a lot of tax shelters around. But even today, there are people who come in with these oil deals. I just have a friend of mine, I use that loosely, but he's someone I've known pretty well for a long time, and he just went to work for an oil company. And I asked him a curious question. I said, did you talk to the attorneys and whatever to make sure that that oil, I mean, because oil is down to, what, $40 a barrel or something. So you got to be real careful saying, hey, okay, I'm going to put 25 or 50,000 a deal because I'm going to get 100% write-off. Got to be real careful. We're really dedicated to the financial education of professionals. Our firm has, as I said, 3,500 to 4,000 clients. Only reason I don't have a real number is because we have a couple of our divisions in health insurance, which is just huge because of Obamacare, where we don't keep real good count of how many of those people are really on the client list. And the issue comes in that we have to be real careful, but we talk about cost reduction strategy, cash flow management, building net worth, and asset protection. Is that what we look at? So we're just constantly trying to create less tax and more net worth. And tax savings at any tax bracket is as important as your return on investment. So if we're doing good tax planning, and that doesn't mean tax shelters or any of the other things that I talked about, but it does create current cash flow. We don't want to prepay government. Do we know the amount that we owe when the return is filed? Do we know before the year ends so we can plan? Now, interestingly, physicians are truthfully the worst at this. I hate to say it, I love you all. I got 300-400 doctors as clients. We've done a lot of resident seminars for Baylor and for a lot of Methodists, all the various hospitals all across the state, and back going a few years in Florida and whatever. So we've done a lot of resident seminars, and what we try to do is we try to convince them to know where they're going. In our firm, people on a monthly basis, depending on the amount of income, we could be calling the doctor. I have one doctor who is huge. I mean, makes a lot of money, and it's okay, but on a monthly basis, we're pretty much keeping track of what he's going to owe. So we could balance his withholding or his estimated tax planning, so we can make sure that, you know, things are copacetic, as we say. And we need to know before the end of the year. And in December, we're actually trying to do the planning. We're doing the planning all year long. But by December 31st, a lot of people who are making money need to pay in a final amount. Sometimes you need to do it by January 1st. Sometimes you need to do it by January 3rd. Sometimes you have to have it in by the 15th. And so we're trying to tell people what they owe. And doctors are the worst, because what happens is we'll say to a doctor making a lot of money, gee, you owe $50,000, you owe $75,000, and they say, okay, we'll get it in. Or do you want us to do it for you? You want us to do it through the government system, you know, electronically? No, I'll take care of it. And then if you go along a little further, we're getting the information in. Well, doc, did you make the estimated tax payment? Well, you know, something came up. Well, what came up? Well, my spouse wanted to buy a new house, one new BMW, or whatever it might be. So we put the money there, and we'll pay the tax now. Okay, well, I'll tell you the truth, those are the ones that, you know, at the end of the next year, we're still trying to talk to the IRS about how we can get the payment schedule to get that tax in. And on all expenses, you've got to remember, if you can deduct an expense, I use this example of life insurance. It's really a bad example. But the amount of $1,000 which are deductible costs us $600, but if after tax it costs us $1,600. So you got to remember, if we can deduct something, it's much better to deduct it before tax, not after tax. are we pre-planning? It's not necessary to know where you've been, but where you were going. And I think that's the biggest problem with most people. We need to do really good planning. We need to sit down and think, okay, what do we want to do? If we're close to retirement, we need to know, okay, what are we going to need, and do we have to hustle a little bit more to get that money put away so we can retire? In today's world, of course, with Social Security and whatever, it's very difficult. So, and it's our responsibility. In Mexico, I gave a lot of seminars in Mexico for people who own property down there. And I had the Hacienda, which is the Mexican IRS, come up to me and said, you know, Mr. Glazer, you do a real good job, but you know, in Mexico, when you talk about planning, that's tax fraud. I said, are you kidding me? I said, in the U.S., that's our obligation, is to do the planning, to make sure we got the tax paid in. Well, we don't believe that. I said, well, sir, I appreciate you telling me that, but really my seminars are geared to Americans, U.S. citizens, green card holders, who don't have to worry about the Mexican tax. All we have to worry about is U.S. tax and what forms and things we have to fill out to make sure that we've got it taken care of. And as I said, tax planning is our responsibility. Health issues and catastrophic planning is our responsibility. We got to worry about it. And today with Obamacare, I don't know about anybody else. I'm, of course, in Medicare, and I've had some health issues, but you know, and my insurance has covered everything. But we really have to think about where we're going. I have clients in Ecuador, and I had two 65-year-old ladies, and they got very angry at me. I was doing a seminar down there, and they got very angry. I said, you really can't afford to go to Ecuador. You don't have the money. And what if you get sick? How are you going to get back? You know, you got to have money to pay for the airfare. You need to make sure that you're in a position to do that. What if you want to come and visit your grandkids? You know. Anyway, my comment, which is usually typical of me just saying something that gets people upset, I said, you know, did you ever think about going to the place in Florida where you know, I forgot what they call that. They do the advertisement all the time about the golf course and whatever. They're single wide, double wide homes in Florida. And she said, that's insulting. I said, hey, you're hiring me to tell you what to do. I'm telling you, you can't afford Ecuador. No, the rent is really cheap there. The food is really cheap. I can get by on $1,000 a month. I said, yeah, but you're going to run out of money. You don't have enough depth to do that. So we all have to think about where we're going, what we're doing. You know, my wife and I work really hard, and I sometimes get a little out of control more than her. She's a very conservative lady. But the point is that I really think that we all have to look at what we're doing and where we're going. Things happen, and we got to be prepared. We have to think about our estate planning, which is another big issue. In today's world, of course, estate tax, if you have over $10 million, you got a problem. Of course, that's a very minute portion, I think, of the U.S. government, but some people have $10 million. We're working on a estate right now where the doctor had probably $20 million. We were able to distribute that extra $10 million to his children over his lifetime while he was still alive. He just died. We have zero tax on his estate. So, and of course, do we have the proper structure to protect assets, to reduce income tax, to reduce estate tax, to educate children, to do marriage planning? A lot of you, if you're young and you're going to plan to get married, or if you're older and your children are going to plan to get married, you have to make sure you have enough money to take care of what you need to do. I think my son's going to get married here soon. He said, I don't want to spend a lot of money on a wedding. And I understand that. It gets expensive. And anybody who's a parent who's had a child that's getting married, you know, the numbers add up quickly. I have 3 children, and it's a lot of money. It's a lot of money. So it's a question. And unfortunately, I say unfortunately, 2 are girls, and 1 is my partner. So having my son is My two ladies, of course, by the time you get through, the number is astronomical. I hate to say that. It's more than I even want to think about. One of the things we have to think about is, what can I deduct to reduce my taxes when self-employed? Well, you can, of course, deduct 100% of your business expenses, continuing medical education, other personal business expenses, except auto for business is only the business portion. And here's a very good point on auto. A lot of people use mileage instead of actual. I always make our accountants check what the actual expense is versus the mileage. Because sometimes you might drive a small amount of miles, yet it might represent 75 or 80% of your total business usage. And so if you spend $2,000 or $3,000 on repairs and maintenance and gas and whatever, 75% of that might be more than the 53 or 50, it was 56 cents, now it's 53 cents a mile, so it might be more. If you're Raphael, who's also in the real estate business, he drives 30, 40,000 miles a year. So his deduction for mileage is a lot greater than his actual expense. Although I sometimes wonder, but we keep pretty good track of what he's doing. And of course, 100% of health insurance is deductible, either on page 1 of your 1040, or if you have a corporation, you potentially could have a medical reimbursement plan that would take up the excess medical costs that you might have for prescriptions and whatever else there might be. In the old days, doctors, of course, used to trade off, right? But with Stark, which I'm pretty familiar with Stark, that stopped. You can't do what you used to be able to do. That's why organizations like the Park Hospital Group had a problem, because you end up with a situation where the doctors own the hospital. They can't necessarily put patients in the hospital and make money off of it. It's a real issue. So people have to be thinking about what they're investing in, how they're investing, what they're going to do, and whatever. When you're incorporated, of course, medical insurance, potentially disability insurance, and life insurance in a qualified plan could all be deducted. Charitable contributions are either 30 or 50% of adjusted gross income. Health insurance and dental, vision, and medical exceeding 10% of adjusted gross income. 7.5% if over 65. Of course, mortgage interest and real estate expenses are deductible. And the additional IRAs, health savings account, which I'd recommend everybody to establish one. Health saving account is a tremendous, for myself, it really saves a considerable amount of money being able to write off all my prescriptions before tax. So it's like $6,600, $7,600 if you're over 55. So it's a considerable amount of money. Or if you have, unfortunately, a parent that you're taking care of, or a child that is sick, it's a tremendous thing to have as a health savings account. This is just on a personal tax return. You have standard deduction, married, filing, joint, head of household, single. But again, we have to look at all your itemized deductions to see which is best, and we're constantly comparing. So we're always looking at auto expenses, itemized expenses to see what is the best method to file, and we do comparison on all of that. One of the things on estate plans that I use a lot is family limited partnerships, because as being physicians, for those who are physicians, I assume all of you are pretty much physicians in this room, family limited partnerships are a tremendous way to protect your asset, especially in the state of Texas and the state of Florida. I do a lot of work in Florida too. Those are the two best asset protection states. Because in Texas, you can have a family limited partnership, and if you get sued, all the people who only thing that the people who sue you get are the right to pay the income tax because of the family partnership rules in the state of Texas. So it's something really to consider if you got an estate, and even though the estate tax is excludable, you know, down under $10 million, it's all excludable. It's still good to think about doing a family limited partnership. I have two because I've been married a couple times, and so it's a way for me to make sure my assets are protected. You know, no one thinks they're going to make a mistake. No one thinks that they're going to have a problem. But if it happens, you want to try to keep as much as you can of your assets. And it's a question of reposition your income. That's the other thing we do in the planning stage. We're constantly looking at multiple business entities. Some people like, most accountants, by the way, use sub-S corporations for two reasons. One, they think they don't have to report all of it as salary because they can just distribute it and call it a dividend. And others, like the C corporate, like me, because I feel like in today's world, you almost pay less tax if you're a C corporation than you do personally. Because personally, we have the additional taxes brought on by Obamacare. It really needs to be looked at carefully. The thing about sub-S corporations is if you take too much as a distribution, the government looks at your tax return, and they're doing more and more by computers. So if you made $200,000 net and you took 150 as a dividend distribution and 50 as salary, the government's going to look at that and they're going to come in and tell you that you're not taking enough salary. You know, so they don't, because you're not going to have to do Social Security on dividend distributions. So you really have to look at it carefully and not abuse that. It's one of the things that pops up. We do a lot of tax protection, you know, tax defense. And my tax manager, who happens to be Canadian, I used to think I was good, but he's really good. He's got that Canadian, I don't know anybody knows Canadian people, but they have that real laid-back type of personality. And what he does is he catches the IRS off guard. Hey, we're working with you. We want your job to be good. We want to make sure, you know, all we're interested in, get everybody compliant. What can we do to do that? We're going to try to get them on estimated tax payments. We're going to try to get their withholding up. We're going to try to do whatever is necessary to make sure that they get caught up. We've had many cases. We have a big doctor here in San Antonio, actually, Raphael and I had a meeting with him. We met him actually in Panama, I believe, through another client of mine who was with him on this trip. And he said, we went over to visit him at his house. He said, I've got to go bankrupt. I said, what do you mean? He said, well, I just got divorced. I have all these bills, all these credit cards that I promised to pay. The judge made me promise to pay. I got all these issues, and I owe all this tax. I don't know what to do. Well, today, not only has all that been paid off, but he's moving forward. And it was just by a good plan. You know, because even if we haven't done the planning, if you back up and say, okay, what is going to be our plan for tomorrow? And we started his payroll. We had 70 people working for him. So we started doing his payroll by direct deposit. We started paying his credit cards. We started put him on a plan to start paying currently his income tax on his salary. And then we started getting him on a program to pay like $1,000 a month and pay the $150,000 he owed on back taxes. And it was a plan. And today he's almost completely debt-free. And you look at things and say, well, you know, I don't have a problem. Well, a lot of people say they don't have a problem. A lot of people do. And the point is you really need to look at all that and get someone who can help you get out of it. David actually works with another accountant who refers all their tax cases to us. And I think he feels very sorry for this lady. He knows her really well because she's got a real problem on some of the things she does bookkeeping-wise and tax-wise. So we handle a lot of her tax cases, which are pretty much she's created for her clients. She's created it. So what we got to do is we got to think, okay, what are we going to do? How are we going to do this? The other thing that we got to look at is the qualified plan. And the question is the type of plans and the amount needed to retire and how we're going to evaluate it. Again, planning. Probably my middle name, planning. Like I said, we have certain pension limits, defined benefit plans. The salary that we can fund for is $265 today. It was $255 back in 13, and defined contribution limits are $53,000. 401k salary deferrals are $18,000. If you're, of course, over 50, you can put away $59,000. So there's things we can do to put money away. And people say, well, you know, I like my defined contribution plan. And I say, have you ever thought about a cash balance plan? Well, what's a cash balance plan? It's a combination profit sharing, 401k, and a defined benefit plan. And if you look at this example, this is a salary deferral and a profit sharing plan. You can see owner 1, 2, 3, and 4, they're getting a bunch of money. They're getting $100,000, $200,000 out of $232,000. So they're getting about 89% of the total contribution. But how do you ever know if your accountant doesn't say, hey, let's do some projections. Let's look at it and see what fits your scenario. Our doctor here in San Antonio, he has 70 employees. So it probably doesn't work. Well, he's got a problem with Obamacare, let alone anything else. But it's okay. The guy does very well for himself. He's very, very well-to-do. And if you have a 401k and you put in a cash balance, you have salary deferrals, and you have safe harbor, what they call safe harbor rule, and the profit sharing, and then you have the cash balance. You can see all of a sudden he's getting the 4 owners are getting 92% of the total contribution. But if your accountant never says to you, have you looked at it? Get a census into the guy. Say, hey, I want to look at this. What can you do for me? Our firm, when I talk about planning, we of course, as you would know, we have our own pension administration unit that we have, and this is what we say to everybody. Not everybody, you know, some doctors, I have doctors who make a considerable amount of money, surgeons, and they say, oh, we don't need to save. We need that money. We need to live in, I'll use the word Beverly Hills or Highland Park, right? We need to live in a classy neighborhood. That's where we need to be. Okay, so you need to spend all your money now. And I look at it and say, no, I want to save some of it for tomorrow. I don't want to live in an apartment when I get to be older. I want to live in my house. I want my house to be paid off. Right, you know, so I'm not looking to live in something that I probably could afford, but I don't want to afford. And so we look at, hey, even at my age, I'm still deferring into my 401k plan, even though I have to pay tax every year on the amount I have to distribute. You know, because if you get over a certain age, you have to distribute your retirement, but I'm still putting away at the same time. I'm still on salary. I still work, I don't know, maybe 50 hours, not 50, maybe 35, 40 hours a week. They try to get me out of there. I start at 7:15. I leave at 3, but then my phone, which is in my pocket here, is on constantly. So by 8, 9 o'clock at night, maybe the phone calls stop. And that's the other thing about our firm. We are available, and specifically me. My son yells at me all the time, turn off the phone. My wife says, turn off the phone already, it's enough. But I have clients in Australia, New Zealand, Hong Kong, you know, China, you know, France. So, you know, so I'm either they're earlier than me or later than me. My Hong Kong guy who was a doctor, he's in the pharmaceutical business. It's what? It's noon here. It's like 1 o'clock in the morning in Hong Kong. So he's calling me at all times. So you look at it and you say, gee, how can I say no to him? He's a good client. So we all have to think about all of this and make sure that we're doing our planning. And this is just, I'm running out of time. This is the family limited partnership. A lot of people have a lot of that, when you talk about having a side job. Some people have this doctor who just passed away, great guy, but he was 80-some years old. But he had oil business, he had cattle, he had all kinds of stuff. Well, we had a family limited partnership. So we had a family corporation, we had a partnership, and we created another entity. Oops. This is the family limited partnership. So we have, a general partner. We have a family limited partnership owned by the husband and the wife. We have income tax planning, estate planning, asset protection, just all kinds of. And that general partner could have a defined benefit. So there's all kinds of things you can do. The other big thing, of course, this is what I was talking about, the 3.8% Medicare tax. In today's world, if you own a home and you bought it right, you could end up with a big profit. If you make over $250,000, you got an extra 3.8% tax to pay. So you got to be real careful. That is a real serious tax hit. There's a lot of people who have a home they've paid off, and now all of a sudden it's worth $1 million because of the neighborhood it's in. You might say, well, gee, no, that's not true. Well, I know lots of people. We were just with someone, I think it was just yesterday, who was saying that he lived in one neighborhood, and I know what neighborhood it is because it's in Dallas, and then he moved to a different neighborhood. Well, I mean, there's a lot of profit in some of those neighborhoods. I bought my house for $230,000. It's worth $600,000 today. So you sit back and say, gee, how did that happen? Well, real estate in San Antonio, Dallas, Austin, it's gone up tremendously. Health insurance, we can get a tax credit, although medical practices, I don't think it's realistic. But again, we have our own health insurance expert in our staff. A separate little guy who does just, well, he doesn't do just, but he does a lot of health insurance. And the other thing that's happening, I have a lot of doctors who have a lot of real estate investments. You got to be real careful about what you deducted because it's a passive income scenario. It's passive. So you got to have a real estate license. We have a client actually here in San Antonio also who she actually was a medical drug person who went around to the offices selling, showing prescription medicine and whatever. And she had plenty of time to work on her condos and stuff. She had like 8 or 10 condos. And we had the case won. She was under audit. And her husband, they were at a meeting, and Art Rothenberg, who's my compliance CPA guy in my office, said to the husband, don't say anything. Neither one of you speak. Let me do the talking. And so in the middle of this big meeting where the agent was about ready to say, okay, I'll give it to you, okay, the passive losses, he said, the husband, oh, gee, she works a full-time job with the drug rep, but she spends all these hours taking care of the condos and stuff. And the agent said, well, you can't deduct this. You're not a real estate professional. It just so happens there was a talk about reading. There was just a tax case that allowed that, where because she only worked 4 or 5 hours on her job, and she was working from noon, 1 o'clock until 7, 8 o'clock, taking care of all the condos, because she was cleaning them herself, painting. She was doing all that herself. Again, we've got to use our head. We've got to do the planning. We've got to think about what's going on. The other thing is, if you haven't filed your 15 tax return, there's been a lot of, and we, I think David didn't bring me the, we have some sheets. They passed some extensions both last year and this year. So if you haven't filed your tax return yet, or if you have, you need to look at what the extension, this extender bill is, because there's laws that passed. They've added on depreciation improvements. So you can write off $500,000 of your medical equipment. I have a dentist who's putting in 3 or 4, what she calls lanes, 3 or 4 lanes in her ophthalmologist. She's putting 3 or 4 lanes in her new office for new ophthalmology doctors, and you know, she can write off up to $500,000 of that equipment all in 1 year. All in 1 year. So you got to look and see what they passed. You know, there's some benefits. There's some changes in the law that on December 31st, they passed the law. Congress is so good to all of us. And I don't know how many people out there paying taxes didn't get the notice because their CPA, accountant, whatever it was, didn't tell you that, hey, did you buy any new equipment? I have people where I say, hey, did you do this? And it's on the 15th or whatever. Well, if you're going to buy a new car and you need a Suburban or something, which is over 6,000 pounds, you ought to go buy it today, because you're going to get almost 100% write-off, because there's bonus depreciation and there's Section 179. Now's the time to buy the new equipment, to buy the 6,000-pound vehicle, if that's what you need. Buy it. And some of this stuff has been extended forever, or for 2 or 3 years. So you really need to start asking the questions. Whoops. Man, going the wrong way here. This was the passport thing, and I think I'm running out. Do we have someone following me? Yeah. Mileage. Audits, just as a quickie, as a final. Anybody making, and hopefully all of you are, anybody making over $1 million really a pretty big risk of being audited. 250 to $1 million is a little less, but they're looking at it. And Schedule C's, no matter what it is, you have a real risk of being audited. So truthfully, you got to be very careful with this too. You got to make sure. I don't believe anybody should be practicing today on a Schedule C as a sole proprietor. You should really be incorporated, even if you're just making $50,000 in this practice. You should be incorporated. It saves, you know, even sub-S corporations are subject to audit. Partnerships are subject to audits. These are things, they're looking for these flow-through entities and for things on your personal return. Yeah. Where do we get started? Monthly financials, quarterly salary decision, annual tax meeting, fine-tuning and discernment, pay all tax due on the W-2, which will save you penalties. Why us? Because we're excellent. We're better than excellent. We're A+. We try to provide sound financial information, help you identify goals, offer complimentary consultations. This is how you contact us, and it's all in the booklet. We have Raphael, who works South Texas, so we have someone here in the South Texas region. Our main office, of course, is in Dallas, and if you look in the booklet, here's what we do. We do a free review, get 3 years of tax returns, we do a free review, and then we give you an idea of what the cost would be if we do the returns. So, but we don't charge for the review. We don't charge for telephone conversations. We feel like we're doing seminars, we don't charge for it. Why would we charge to talk to you individually? So, and I feel you got to develop a lifestyle plan. You got to decide where you're going, what you're going to do, how you're going to do it, what do you need. You know, very costly in today's world, as we all know. I want to thank you, and if you have any questions, please write them down, get it to us, or email. I promise you, you'll get an answer.